Everyone is talking about Jio Financial Services. Millions of retail investors piled into this stock simply because it has Jio in its name. But when you open screener.in and look at its numbers, something looks completely upside down. A PE ratio over 81x when the industry average is sitting around 20x. So, is Jio Financial Services a 1.68 lakh crore rupees power giant waiting to explode, or are you walking straight into a classic valuation trap? Today, let's pull up the exact balance sheet figures in rupees, skip the textbook jargons, and calculate its actual fair value together. Look, it's completely natural to be bullish on the Reliance brand. When Jio Telecom launched, it wiped out competition and changed Indian digital infrastructure forever. So, when Jio Financial Services demerged, retail investors thought this is Bajaj Finance 2.0. Let's buy as much as possible. But here is where retail investors get caught. Once you open your broker's app, see the stock trading around 256 rupees and check its earning per shares, over the trailing 12 months, Jio Financial's EPS sits at just rupees 3.13 per share. Now, let's do the simple math here. Price divided by earnings. If you take the current stock price of rupees 256 and divide it by its earning per share of 3.13, you get a sky-high PE ratio sitting right around 81.5 times. An 81.5 PE ratio makes the stock look ridiculously expensive. If you judge JFS purely on PE, you may either panic and sell it right now, or you are assuming that it is overpriced bubble. But evaluating an early stage financial institute purely on traditional PE ratio is the first big mistake. A manufacturing company like Tata Motors uses factories and machinery to make profits. A tech company uses codes. But a financial institute, whether it is HDFC Bank, Bajaj Finance, or Jio Financial, uses money itself as its inventory. They make money by deploying their capital. Therefore, one shouldn't only look at what they ended last year, but must look at what equity assets they own today. This is called book value. Let's look at Screeners.in's consolidated balance sheet for Jio Financial Services. JFS has total equity reserves and capital backing it up, giving it a consolidated book value per share of Rs 208. Now, let's calculate the price to book ratio. If you look at the balance sheet math, dividing the Rs 256 share price by its actual equity book value of around 208, the stock is trading at barely 1.22 times its net asset value. Suddenly, the picture changes completely. While Bajaj Finance trades at a price to book multiplier of around 5 to 6, Jio Financial is trading at just 1.22 times. That means at Rs 256, you aren't paying a crazy 80x premium for physical operations. You are paying barely 22% over the cash and liquid treasury assets sitting right inside their balance sheet. Now, this brings us to a massive dilemma. If a stock has a low P by B ratio or a low PE ratio, does that automatically make it a bargain? Not necessarily. This is where investors fall into a valuation trap. A valuation trap happens when a stock looks very cheap on paper, say a PE of 5x or a P by B under 1. But the core business is slowly dying or burdened with the bad debt. Think of old legacy PSUs or struggling telecom firms from a decade ago. They look cheap, but your capital decays over time. So, to test if a high PE stock like Jio Financials is actually overvalued or just waiting for growth, professional analysts use a simple formula popularized by Peter Lynch, the PEG ratio. When you run the math, dividing a company's price to earning ratio directly by its expected earnings growth rate, that single number gives you its PEG ratio. If the PEG ratio is 1, the stock is fairly valued related to its profit growth. If it is under 0.8, it is potentially a deep value. But if you check JFS on financial metric platform, its current PEG ratio sits near 9.79. Why? Because its earning growth hasn't caught up to its stock price yet. And that brings us to the core question of this video. To give an honest valuation of Jio Financial Services, you have to split the company into two distinct parts. Part 1. The safety net. JFS holds a massive treasury stake of Reliance Industries share. That liquid equity provides a rock-solid floor around its 208 rupees book value. This is why the stock price doesn't crash like speculative startups. Part 2. The execution engine. JFS is building out consumer lending, merchant UPI payments, insurance broking, and a massive joint venture with BlackRock. Right now, the profit from these new businesses is just beginning to reflect on the quarterly income statement. So, when you look at the PE ratio of 81.5x, you are looking at a snapshot of a company that has not yet fully deployed its massive cash pile. And the final verdict. Is Jio Financial overvalued? On immediate trailing profit numbers, yes, it commands a steep premium. But on a balance sheet assets and price to book multiplier of 1.22, it is well protected by its asset floor. You aren't buying a cheap dividend stock today, you are paying an execution premium for the Reliance distribution machine. Now, Jio Financials isn't the only stock in India where retail investors pay a heavy premium for brand power. There are more. Subscribe to 3S Wealth for more such valuable insights.